We have just received new information and new data that suggests that the worst is yet to come for the US economy. But as you can see here, a lot of strategists are divided between whether this is a bear market rally or a new bull market. If you look here, Wells Fargo, their top analyst says that the bear market is completely over. Whereas Morgan Stanley, they say that the S&P 500 could drop 26% in a couple months. As we know, only one of them can be correct. And in today's video, we're going to be discussing the data and the research behind who will likely end up being correct. Before we get started, join me and 10,000 of my friends on Substack. Also, make sure to follow my friends on the platform where we cross-recommend each other. On Twitter, I share thought leadership on the markets. Follow me at Larry Chung, CFA. Now, Morgan Stanley's recent strategy note talks about the death zone for the S&P 500 equity risk premium. Now, for those of you guys who aren't familiar, the equity risk premium refers to an excess return that investing in the stock market provides over a risk-free rate. Now that cash is yielding 4.5%. The strategists at Morgan Stanley say that the risk reward for the S&P is quite poor. You add this on top of the recent geopolitical tensions between the US and China, and markets have a lot to grapple with. All of this is coming at a time when folks think that recession likelihood is actually coming in lower and growth fears are actually receding. But as I'm about to show you now, there's a lot of data that suggests that the local economy for a lot of folks is about to get a lot worse. Look at this here. Temporary pandemic SNAP benefits will end in remaining 35 states in March 2023. Now, I know a lot of my friends on YouTube, you guys are more on the affluent side. You guys are more on the white collar side. But for those of you who don't know what SNAP benefits are, these are the food stamps that millions of Americans are entitled to if they fall below a certain threshold for income. Look here, SNAP stands for Supplemental Nutritional Assistance Program. And in the US, this program is a federal program that provides food purchasing assistance for low and no income people. Why does this matter? Well, 12% of the American population depends on SNAP, the food stamps. And as of March, the beginning of March, the pandemic SNAP benefits, they're going to end for millions of people. Let's do some macro understanding of the demographics. In the US, there are approximately 332 million folks. Now, 32 states are set to cut these food stamps in March. How many people were on food stamps up until this point? 42 million. We're talking about more than 11% of people about to see a huge reduction in their ability to purchase food. Look here, losses will vary across households, but average three-person households will lose $197 when SNAP emergency allotments end. That's happening in just a couple weeks. Now, given that 10% or more of the US population will have to start spending their limited remaining resources on food after these food stamps expire, this means there will be less money for other forms of consumption. Now, where is all this money going? Well, you probably know it's going to Ukraine, but I'm not going to talk about that in this video. Look at some anecdotes from the Guardian website from journalist Jessica Fu. She writes that Nicole Stevens, a hardworking single mother of 2 teenage boys, was able to spend about $300 on her family's monthly supermarket haul. Now, after the aid is going to get cut, she's going to scratch her head and wonder, how is she going to put food on the table? And this is going to impact 40 million Americans out of the 330 million people in the US. If you think this doesn't impact the US economy, well, think again. Now, this was so serious that people even got emails from the Department of Human Services. Look here, from the Colorado Department of Human Services. This is some real things going down as we speak. They're sending out emails to people saying, stretch your ingredients and plan to use them in more than one meal. This helps to save money and reduce waste. Also, consider freezing your produce to make fruit and veggies last longer. This is a change enacted by Congress and is not appealable. Like I said, For a lot of people, the worst is yet to come. Yet Wall Street thinks that the economy is extremely strong. Look here, is it mass layoffs or is it a hiring boom? What's actually happening in the jobs market? Well, what I want to remind our friends here is that a lot of the jobs that have been created are in sectors like healthcare, education, leisure, and hospitality specifically, and other services such as dry cleaning and automotive repair. Now, I've talked about how there is a transition from white-collar work to blue-collar work, and that is exactly what's happening. So beneath the surface of a very strong unemployment rate, the truth of the matter is there's a transition from people being paid very well in white-collar roles into roles that are more part-time in nature. So a further decrease in the unemployment rate is simply more people working in jobs that can barely sustain the cost of living. Now, of course, that is just my opinion. Now, there is this grand question that inflation will go down, right? Almost everyone expects inflation to come straight down. I'm about to show you some data and some graphs that suggest that perhaps that assumption might not turn out to be true. Look here, Russia and China have a stranglehold on the world's food security. In fact, Moscow's invasion of Ukraine heightened the role of fertilizers and who controls them as a strategic lever of global influence. If we take a look at this chart on fertilizer giants and what it takes to create fertilizer, nitrogen, phosphate, potash, we can see that China and Russia are responsible for a large part of the production. And yes, China and Russia are forming a stronger alliance against the West, which is making geopolitical tensions heat up. Geopolitical tensions was one of the reasons I discussed why the S&P 500 at 4,200 and Alibaba at 120 were dangerous levels inside my investment community. Make sure to check that out in the link in the description below. Now I want to walk you through some data from Bank of America, their fund manager survey that I believe you will find very helpful. Look at this. They are looking at 10 factors to watch to mark the bottom of the bear markets. And as of the latest month, only 4 out of the 10 factors have been checked off, whereas in previous bear markets that have ended, 80 to 90% of the items have been checked off. Bank of America is also showing that the S&P is still statistically expensive on most measures. You can look at it from a PE perspective, forward PE perspective, book value perspective, cash flow perspective, in terms of gold, in terms of market cap. All of these metrics suggest that the S&P 500 is still expensive. What's even more worrisome is that a lot of retail traders now are using 0 days till expiration options contracts on the S&P, which could elevate volatility in the markets. If we look at a chart between the S&P 500, the inflation, and the PE model, we can see that the current market has priced inflation as if it's back at 3.1% if we look at the curve. But if we take a look at where the markets should be in terms of valuation because of the inflation that we're at 6.5% or so, the PE should be around 12 times. Currently now, it's about 18 times. A lot of market participants, they think that the Fed is going to peak rates at 5 to 5.25. But as we know, those terminal expectations are inching higher. In fact, there's only a minority of people that think that the Fed will take peak rates to 5.5%, as we can see here from the chart. It looks like 5% or fewer of people believe that's the case. But what if it does happen? The markets are not pricing that in. Market participants think that the biggest tail risk remains higher for longer for inflation, whereas geopolitics is second. Now, personally for me, I think in this environment for the next 3-4 months, geopolitics is equally as important as inflation. And I'm going to be keeping you guys and my private community updated on the situation between the US and China. Now, we can see here that in terms of the crowded trade, a lot of fund managers were very long into China heading into February 2023. Unfortunately, we saw a large retracement in China, which I had seriously warned about publicly and privately. So hopefully those of you guys who follow my work closely, you have avoided most of the retracement, and you're ready for a thoughtful re-entry later on. A lot of people also think that the Russia-Ukraine conflict is expected to continue through 2023, and I have to agree with this. I think the war is about to heat up and it's not getting any better anytime soon. Let's talk about some corporate fundamentals from Walmart and Home Depot, which are two of the biggest retail names inside the S&P and two of the biggest names that represent the US economy. Look here, Walmart and Home Depot, they're getting ready for a consumer slowdown. I want to walk you through a couple observations that I found in their earnings transcript to help you dig beneath the headlines. Walmart, they talked about how their China division was relatively strong. They talked about how US consumers were being more thoughtful about their purchases than ever. But this is what caught my eye. Walmart talked about that they are making significant investments in automation going forward. And why is this important? Why does that matter? Because for an investor, when Walmart invests in automation, that's going to lower their cost structure, improve their operating margins. But I want to remind you that Walmart is one of the largest employers in the world. In fact, they employ 2.3 million people. And if they find efficient ways to automate parts of their workforce, that is going to lead to a restructuring in their headcount going forward. You can see here that Walmart is focused on changing the business model such that the operating income can grow while still having low prices. Now, I want you to think about that for a second. The only way to be able to sell at low prices where you still grow operating income, the only way that's possible is to lower operating costs. And that means headcount for Walmart in the future might be subject to evaluation, if you know what I mean. Look at this, Home Depot, they're targeting flat growth in the foreseeable future. Home Depot also discussed that the big ticket division for them is impacted more, and they did finally admit that the consumer is experiencing some softness in their consumption. 2 quarters ago, when I made a video on Home Depot, feel free to check it out on my channel, I discussed the fact that Home Depot said that there were no cracks in their outlook. 2 quarters later, they're finally succumbing to the fact that the economy is in a deeper slowdown. On top of this, there are a lot of geopolitical concerns between the US and China. I recently talked about in a strategy note to members that investors with semiconductor exposure, tech hardware exposure, with supply chains to China, with EV exposure, and China ADRs, all of these thematic groups in the market, you have to follow the US and China relationship closely, because as of right now, I think that the relationship is going in the wrong direction. I discussed how the White House, they can provide pressure to the PCAOB, which is the Public Company Accounting Oversight Board, and on how they can revisit audit documents on Hong Kong and China companies. That can happen. Remember, nothing is ever off the table. And we can see here that China urges state firms to drop Big Four auditors on data risk. And then President Xi is talking about China speeding up basic research to counter US semiconductor export curbs. So the US-China geopolitical tension is just starting. Now make sure to join me on Twitter for thought leadership on the markets, where I comment on US and China market strategy very frequently. And then also join me on Substack, where I share a lot of premium exclusive research to our public friends. Oh, and before we wrap up, I have a special message for you.